Hi everybody, I wanted to make a video today about the modern gold bullion and silver bullion revolution and how the marketplace has changed so dramatically from what it used to be decades, centuries ago even, but particularly in the last 20 years, 25 years, I would say it's changed significantly. So without further ado, I'm going to read straight from my paper. Here we go. The modern gold bullion revolution. Many buyers of gold and silver are unaware of what bulk dealers of precious metals like APMEX, Provident Metals, Shift Gold, bullion exchanges, and other major bullion outlets who have revolutionized the precious metals marketplace, what they have truly accomplished. It used to be that potential purveyors, novices, and newcomers to coin collecting and bar and round purchasing segments of the bullion market had to go to a local brick and mortar shop and maybe the rare or occasional coin show where they could see what the prices were for coins or gold or silver. Naturally, the prices were all over the map depending on where you lived. Some shops paid barely over face value and sold for 150% of spot back in 1980 when spot hit the highest levels seen at that point in history. Others paid 50 to 60% of spot back in 1980 and sold for 150%. Sorry, 120 maybe. And that would be considered pretty great margins for today, considering that APMEX often buys for 100% of spot or very close, sometimes even a little more than spot, depending on the item. And they can sell for 110%, which are considered considerably tighter margins than were even possible decades ago. The truth is that when the margins of an entire marketplace get tighter, it means that initial sellers, the source for the bullion dealers, are getting greedier and or buyers are getting thrifty, or maybe the overhead of dealers has shrunk, and so there's not as great of a need for as great of margins. Or maybe their customer base has grown so much due to the power of the internet that they no longer need to have such wide margins to work with. Or maybe their need to incentivize sellers with higher payouts has grown due to the greater prevalence of sentimental attachment to family heirlooms. Whereas many sellers decades ago weren't necessarily recipients of gifts from their grandparents of old gold or silver coins, and possibly bought or received the coins themselves. The presence of stiff competition and the ease of finding it for end consumers and sellers alike also acts as a bulwark to wider margins, wearing away the ability for a dealer to lowball or overcharge. All of these things wear away at the margins for purchasing and buy and sell prices. And there are a million reasons we could postulate till the end of time on why, but the greater concept of importance here at play is that now for us precious metals investors, no longer does the market have to rise by like 50% or more in order to be certain of the efficacy or worthiness of investing in the volatile nature of gold and silver bullion. Because even if the market rises by a mere 10%, not only has the average buyer from a bullion dealer broken even, but they may even profit by selling directly to other end consumers instead of back to the same dealer. This incentivizes investment in the market as a whole, which is beneficial to the rest of us as investors. In the days of old, when silver was $50 an ounce in 1980, if someone invested heavily in silver bars, for example, and then tried to sell off 20 years later for $2 or $4 an ounce, had they simply bought and sold at spot value each time, they would have suffered a phenomenal 92, 96% loss, just in nominal terms, and certainly more inflation adjusted. I mean, would $2 in 2001 or 2 be the same in 1980? $2? No, and certainly not in scale. $1,000, $10,000. So in modern times, you can still win or lose, profit or suffer depending on when you buy in. But imagine we were still operating under the same system that operated decades ago, where you could overpay when you bought in and get hammered again when you sell, buying for 125 or 150% of spot for just bullion and selling for as little as maybe even 10 or 20% of what you paid. I mean, just dramatically wild swings. The losses and conversely profits would be dramatically altered. Had someone even been lucky and bought in at $2 an ounce in 2001 or 2, factoring in the 50% premium, so let's say actual costs are like $3 or $4 an ounce, and sold at the 2011 highs of about $49 an ounce, selling to a dealer for, say, 15% of spot. Remember, we're going off of the old system, or the chaotic nature of brick and mortar, no internet, no competition, or significantly less access to competition. They would have profited only about $4.50 an ounce over a near decade period, or about 150% profit. And that's assuming the extreme fluctuations of spot going from historic lows to historic highs. But that assumes that that's a hypothetical scenario if the market had never evolved, had never progressed towards the current state. And that's what makes the current state of play so valuable. AppMix and other major outlets on eBay and elsewhere, despite the fees and the shipping and whatnot, this modern system is substantially superior to the old system. The old model was ridiculous. Of course, being no internet in 1980, the only way to check a dealer's prices and payout for being fair was to go around to all the shops in town and see what they pay. However, many cities and small towns didn't have as many coin shops as they did gas stations or grocery stores. So under a lack of competition, many dealers would secretly collude to lower their payouts and even raise their prices, which, despite laws against it, the difficulty lies in proving it. I hate to even say that, but hell, it's true. Back then, if the local coin or bullion shops didn't seem fair enough, you could try calling a company that advertised in the phone book or newspaper. But then you might have gotten the same scams you see on Craigslist and other venues where money orders, wire transfers, Western Union, or some other similar scam is used to con someone out of their money. A common modern-day tactic for the cash for gold business scams is to have people mail their gold or silver to a company they've never heard of, or that probably hasn't existed for more than a few months, which promises to send them a check in the mail based on the value of their broken jewelry, old rings, and gold coins. And actually, remember, this is a true story. One lady, for example, sent in about $14,000 in gold and received a check for $237 in the mail a couple of months later. I remember seeing that on the news a few years ago, back when gold was like, I think it was $14.50 an ounce, and one of the family members remembered weighing it at one point. And yeah, it's crazy to think about something like that, right? And that's in an age when we have social media, review sites, the eyes of justice lent to us by technology, and the hands of it. Imagine the chaos of 1980 or before, when even less verification or security existed, other than crazy buy-sell spreads that could drive any investor crazy. The mere volume of scams, which have always existed, by the way, this isn't just some new phenomenon. They just tend to come out more when gold comes up, and also for silver. The volume of scams was probably enough to deter many from buying and even selling. Imagine seeing a newspaper ad for a 1908 $20 St. Gaudens gold coin for a mere $275 in, like, I don't know, 1984. Would you pay it? All you have to do is send a money order to a company thousands of miles away on the other side of the country, and you can expect your coin within 4 to 6 weeks. 3 months later, nothing has arrived. The police say the address you gave them belongs to a shell company that was set up in the fall of last year. The owner is an unknown foreign national who has disappeared into Mexico with your money and about 10,000 other people's money, who all hopped on the opportunity for a good deal on gold, especially in the tumultuous economy. They'll try to track him down, but the truth is he's really gone, and so is your money. 1984 was a dangerous time for precious metals investors, especially with Reagan trying to ban the import of Krugerrands and all. Nowadays, with eBay's buyer protection programs, AppMex's authenticity guarantees, and numerous other forms of protection, in addition to a paper trail to prove ownership records, scammers have a significantly harder time bilking people out of their money, although it is still possible. But it helps to remove much of the doubt in gold, silver, and coin markets, which benefits the rest of us, current investors, by giving reassurance to newcomers, which may be one component of why the spot price has risen so much, and resistance to it falling, the price inertia has increased so much. Less fear of the metal itself and those buying and selling it. For these reasons and many others, this has culminated into the age of the gold buyer, the silver buyer. This is a time where it's much easier to be an optimist on precious metals than it is to be a pessimist. This is an external of all the typical reasons like the economy and money printing. The fact is that no matter how bad the economy gets, large swaths of the populace don't tend to naturally gravitate towards hard assets because, quite frankly, they're ignorant about and afraid of something they're not familiar with. Many people, they get into stocks because maybe their company offers them shares as an employee, or they invest. They're pretty much limited to stocks, essentially. Hard assets, something like gold. What do? It just sits in a safe? People don't get that. It just sits there. How does it produce value or something? And that's the truth, is that fundamentally this boils back down to the concept of there are two different kinds of precious metals investors. People who believe that precious metals have an inherent value, intrinsic value, and that the value of the dollar changes all the time, but the value of gold and silver never change. I personally am not a proponent of that idea, but I do believe that the price of gold and silver are volatile, and that there are ebb and flow, high and low, and that the time to buy in is low and the time to sell is high. Rare coins, it's a whole different kind of volatility, but they can be volatile, and every market's different. But I would say that people are a little afraid of gold or silver because people are afraid of things they're ignorant about. We don't fear the dark because it's dark. We fear the dark because we don't know what's in it. And so, same thing about investing. And so that's what I'm getting at here. Aside from those who have already been burned buying high and selling low, or just holding, the barrier to entry to any marketplace is always knowledge first. And although seemingly simple to those already in the market, the web of reasons for owning precious metals can actually seem quite daunting, intimidating, and convoluted to those brand new at something they've never known or owned. And also, on top of that note, sometimes access to information or objective information becomes a problem. And then here's the biggest catch: the conflict of interest. The fact is that a lot of people don't understand why, when somebody's selling you bullion and someone says the dollar is being printed so much, get rid of all your dollars, get gold now before the dollar we turn into Germany in the 20s or something, or the Zimbabwe dollar, And if you have to have me explain that to you, just go to Google, look it up. You learn about the Zimbabwe dollar or the German Deutschmark from 1919 to 23. True story, people. Scary story. But people don't get that. Why would you want to trade gold for dollars as a dealer? Why would you accept my dollars as a new buyer to bullion if these dollars are losing value? And a lot of people just go, well, if the dollar is losing value, you should never want it. So this is clearly gold bullion's a scam. Silver bullion's a scam. The whole idea of investing in it must be some kind of a con job, because how can you say the dollar's losing value, but yet you accept dollars when you're selling to me? And that's a key point. That's something people don't understand. That's a difficult concept to convey. It's not very difficult to understand what you're really doing as a bullion or gold dealer. It's very simple. Unless you're making that argument of the apocalypse, I don't think that America is going to hit hyperinflation. People who think that, well, rationally speaking, yes, they would have only bullion, no dollars at all. But I think that there will be inflation. There's always been inflation in America for the most part, and it's certainly in the last 80 years been significantly greater year over year than it was in the century preceding, century and a half preceding. And so I would say that I personally think that silver and gold are better to be partially invested in, rather than not at all. Better to have 5 to 10% of your portfolio in it than 0%. So maybe bigger is okay, but I still think you gotta have something in it, because don't have all your eggs in one basket, but don't have no eggs in your basket. So I think that the truth is that gold and silver, when you buy or sell, inflation is certainly a topic that needs to be discussed. But the issue is that a lot of bullion dealers do tend to be hyperbolic and say, oh yeah, it's going to hit zero. it can hit zero. Its stocks have hit zero. There are some stocks where even though they never hit zero, they're so low in value, less than say $7, that the cost to sell them, like on E-Trade or one of those other sell sites, is like $7 minimum. And so just to sell it costs you more for a transaction fee. And so, but the dollar, it can approach the same point where the paper it's made out of, which is what happened in Germany, the paper it was made out of is worth more than the face value of the note. Anyway, but that's the truth, is that inflation, I'm not so much a proponent of the idea that hyperinflation is coming to America in the next 6 days or something crazy like that. But inflation over the next 5, 10 years, 2 years, 20 years, yeah, absolutely. Clearly, the debt's too great, the national debt, and there's too much spending on the federal level. There's too much quantitative easing. There are numerous complicated financial reasons for why inflation is really going to be necessitated, but hard assets in the face of printable assets. You can print money, you can create gigabytes of data, but you can't print gold, you can't print silver, you can't print land. So hard assets, real estate, gold, silver, certain assets tend to perform better in certain kinds of economies, and for different reasons. Sometimes these assets all move in concert up, or they all kind of float to the bottom together. And other times they move in opposite direction. They have an inverse correlation. It depends on the reason what's a major market move or major economy shaper. And so I would say that real estate, for example, seemed to be going up for several years, for many years, really after Bill Clinton was in office, and that's because the repeal of parts of Glass-Steagall, which made it easier for riskier loans to be given out by banks. And so at the same time, gold and silver tended to go up after 2002 as well, just up, 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 up. But then even as real estate collapsed, gold and silver didn't collapse, and that's because gold and silver weren't artificially boosted by loans from banks. Gold and silver actually kept going up. Silver did have a significantly greater volatility than gold. Gold tends to be backed by governments and banks and corporations and hedge funds for tax reasons and historic reasons, far more than silver. Silver just, it's not as benefited as much tax-wise, and so for that reason it tends to be significantly more volatile than gold, and also because it's the cheaper metal. There's a myriad of reasons why silver, I think, was it 2009 or 8? I can't remember. It went from like $20 an ounce-ish or 17 an ounce down to like $7 an ounce. It went down to like 50% over a period of a few months or a few days or something. And people were saying it was because of manipulation, not really speculation so much, but I think that I think it was part manipulation. I watched a short documentary on it, but to bring to this whole point though, about why silver kept going up and gold, the general trend line. I bring up that one aberration because it was that anomaly. It was only that. That can't truly stem or the tide, the flow of money that was coming in silver and gold at the time of the financial recession. Since the trend line was upward, even as real estate collapsed, gold and silver, the trend line was upward. I mean, they naturally, one day, 1 minute, 30 seconds, it'll be down. 1 second it'll be up, next second it'll be down. But the trend line's upward, and that's the selling point. That's why anybody would invest. That's why I own anything at all in gold or silver. If I didn't think the trend line was upward, I would sell now. So, and really, if you think gold and silver are down for the next 5 years, 10 years, whenever you plan to sell, 20 years, 10 days, well, then sell now. But when you're selling in terms of conflict of interest, or you're trying to convince someone to buy in, you have to be very careful about how you address the inflation, the inflation reasons for buying in. Because if you tell someone, "Oh, well, I'll accept your dollars," the truth is it's about a competition of investments. Gold and silver are not the only investments you can make. I brought up the stock market earlier, and also real estate, but the truth is that this is going to be kind of harsh. This is why it's got to nuance this carefully. When you tell someone to buy in gold and silver, and they say, well, why would you ever accept my dollars? Even if you don't want to tell them this, you have to know that there's a better investment out there other than gold and silver, either at that particular time or just for you. Maybe you're selling because you can use the cash for a medical bill, and obviously the doctors won't accept a gold brick or silver bar. Maybe you're selling because you need to pay for your kids' college. Maybe you're selling because you're not just a dealer, and so maybe you're selling because you have some other investment that can outperform gold or silver. Gold and silver, maybe you had a substantial stockpile or a reasonable stockpile, and you're looking to sell part of it or all of it because you found something else that's more sure, like a personal business, or even if it's not as sure of an investment, like it's not as certain as gold, maybe it's far riskier, maybe even not as lucrative, maybe it's something that emotionally benefits you more, like a personal business, like you're trying to start your own company, and so you have more of a personal investment in it rather than just a purely financial investment, although it requires some financial investment. So there are lots of reasons why you can take your investment, your equity out of gold and put it into something else. And that's something you really do have to convey to people, is that it doesn't necessarily mean that gold or silver are bad investments. It's just that there can be either superior investments in general or superior case-specific subjective investments, like the person particularly selling it to you, which does not overwrite or downplay the importance of the general economy or the general good reasons to invest. Like if a particular millionaire decided to sell me a few gold coins, small ones for whatever, and I say, okay, I'll take them. Maybe he's got some investment for that day or that week or month or whatever, and he just needs a small amount of money, a few $100s, maybe even a few thousand, to put it into that. And he has a net worth in the millions of dollars, but it's all tied up in stocks. It's all tied up in hedge funds and real estate and some business. And maybe the business has debts, but his net worth is in the millions. He just doesn't have cash. This is something a lot of people don't understand, is that you can be wealthy without having any actual cash. Lots of wealthy people have their money tied up in assets. In fact, most people do. If you look up documentaries on the wealthy, something like, I think it's 80 to 90% of all billionaires don't have $1 billion in the bank. They have probably less than half that, less than a quarter of that in liquid cash, because most of it's tied up in some company or in some investment or some capital somewhere. And that's the point, is that gold and silver, in the same way, people can be selling, maybe not necessarily because they want to, but just because they need to raise cash for something else, not even necessarily because that something else is performing monetarily, but because maybe they have to do it for legal reasons. Like maybe they got sued and they lost, and they just have to have the cash, so they're going to sell something that isn't absolutely necessary to them, but maybe they'd like it. I mean, obviously, if something's valuable, you'd like to keep it, but you can't both have the money and keep it, right? And so that's the point, is that when you talk about inflation and selling, that's a very tread carefully, people, because that's a hard one to convey, because I've seen a lot of people, this is probably the #1 point for people of intelligence to just walk away from gold and silver investing, is when you try to make that your single focal point on selling gold and silver to someone. I would advise not bringing that up, at least not initially. If you do, see how it's already taken me at least like 10 minutes to explain this. It's about a competition. Make sure when you talk to them, convey the point that it's about a competition, a pool of investments, that you don't have all your money in gold. And if you advocate that, you're an idiot, because gold and silver can go down dramatically. Never have all your eggs in one basket. And don't advocate that to other people, unless you're stupid. And I'm not stupid, thank you very much. Divest, broaden everything, divide your money. Even if you don't have a lot, just do the smart thing. Keep your investments separated and insulated, complementary, so that if one goes down, the other can go up, so that it all balances out and goes upward. And so when you try to advise people into buying gold or silver, or somebody tries to advise you into it, or a friend is trying to sell to someone or whatever, Inflation, you got to tell people, inflation, certainly I'll accept your dollars when you sell to me, but I'm just going to take those dollars. I'm not going to just stuff them under my mattress. I'm going to take them and put them into a personal investment of mine. And so I already brought up like the medical example and college bills and medical bills and personal business or a loan to be paid off or whatever. But in general, there is always the possibility, and this is probably going to be the worst thing to bring up, but I have another investment that is going to perform better than gold. And so maybe it's something that's backed by the government. It's some kind of a loan or a contract or something that's guaranteed, no way, ifs, ands, or buts about it, to be lucrative. Be careful about bringing that up. Because if you do, then they're going to go, well, why don't you let me in on that? And then it's like, well, now I got to split the profits with this guy. So you got to be careful. And that's just, man, that one's poison. It's the poison pill. Anyway, I'm sorry it took so long to explain, but it's because it's complicated. Because that one you do have to explain that one carefully. So back to my paper though. For these reasons and many other, it can actually seem quite daunting and intimidating to those brand new at something they've never known or owned. The web of reasons for owning precious metals can seem quite intimidating. I bring up current owners or past sufferers because although they think of themselves as knowledgeable, oftentimes it is their ignorance which cost them in the first place, so I count them in the block of uneducated people. Some say it's impossible to predict the highs and lows, but in my opinion, the general idea is simply to buy the metal when nobody is looking at it, such as during the technology boom of 2001. And also, ooh, damn, trying to get this, sorry, my paper's kind of screwed up. And also, don't forget the steep sell-offs of the Hunt brothers Ford in the aftermath of their attempt to corner the silver market. Versus, say, 2011, when all attention was on the Federal Reserve, Obama's stimulus package, and, in general, government spending and inflation. If you're buying at the same time when everyone else isn't buying, you might just be participating in a bubble. You can at least relish in the thought that others are suffering too, if you're willing to be a Marxist about it. However you view it. I am harsh. I know I'm harsh. One cannot deny, you can't deny that the markets for gold and silver and the ways that we acquire it, liquidate it, have changed dramatically in recent decades to the benefit for most people who are investors in it. In the short term and the long term alike, pretty much anybody but small-time dealers, unfortunately. But most of us are better off, and isn't that the best you can hope for? Well, we can always hope for better. Anyway, thanks for watching. Rock on.